Hello and welcome back to the channel. There's been a ton of volatility in the market, especially in the financial sector, due to smaller US banks failing. I took this opportunity to purchase many shares in both TD Bank and Scotiabank, as both of their share prices declined due to just a sector-wide sell-off and nothing to do with the fundamentals of the companies. I decided to sell my Power Corp of Canada position. The Canadian banks are very well regulated and have been paying dividends for hundreds of years. So when Scotiabank offers over 6% yield and TD Bank is offering 4.8% yield, it's a great opportunity for a buy and hold investor. And if you look at their historical averages for their dividend yields, they're quite high at this time, so it seems like a really great time to be picking up these two blue chip stocks. So by selling POW, I get a higher yield on my money and get closer to dripping these two holdings, and they have now become my number one and number two position in my portfolio. I have two portfolios in my dividend portfolio on WealthSimple Trade. So I have $21,203 in the account. My RRSP has 1043.92 and it's up about 16.5% all time. And the TFSA is down slightly, down 3.29%, just due to some of the stocks I have not performing very well, and of course the Canadian banks declining very harshly. And in the RRSP, I actually purchased a new stock, so stay tuned to find out what that is towards the end of the video. Please leave a like and subscribe to the channel so you don't miss any updates in my dividend portfolio. Now let's roll the intro and get into my recent purchases. In my TFSA, we were up 568.74, up 3% in the previous week. And if we look at the all-time, we're only down about 3%, or down 684, just due to the financial sector declining. And a lot of sectors, aside from technology, it seems, have been going into the red. So if we go into the portfolio, we see Apple has climbed up from the previous update, so it's up over $150 again. So at AQN, I purchased one share going up to 57 shares, and they actually had quite a strong earnings report, and the market responded favorably with the stock having a nice little rally on Friday. They raised $350 million from the sale of assets to provide financial flexibility to the company. And in the last earnings, they stated they would raise $1 billion in liquidity, and they had many options to get it done as they have $17 billion in assets. They also improved the credit rating with the company as well. So it looked, questionable previously in the previous quarter, and then the most recent credit rating of the company is that it appears to be stable. And we all know how credit ratings can be important. But did you know that Silicon Valley Bank actually failed because they were actually going to get downgraded from their credit rating? So they panic sold a bunch of assets to try to raise some liquidity, and that's ultimately what led people to panic and start that bank run that destroyed that bank. So credit rating is very important to companies, and Algonquin seems to be doing quite well in that regard. Also on the earnings call, they stated that the fixed rate loans, so the interest rates that are just locked and not fluctuating or floating, is about 90% of the company's debts, which is a great result, and they plan to target at being around the 85% mark for their fixed rate debt at all times. So the management does seem to be doing what they are promising, so I'm more confident holding the stock and letting the company turn around while I collect the dividends, and I plan to just be purchasing a new share of Algonquin while it's trading at these levels, about one share for each deposit I make. And with ATD, they had an earnings report. They missed their top line revenue, but their earnings were an increase over the previous year, so they are still growing. Their profitability metrics are looking strong, and they just announced a new acquisition over in Europe, so that's pretty exciting that they're going to continue to expand the European side of the business, and I'm pretty happy with this company overall. For Aritzia, it actually dropped quite a bit, and it was even in the low high 39, so it went below $40. I was very tempted to grab the stock, but I noticed that Brookfield Corp and Brookfield Asset Management were in a decline, And these are positions I really want to build for the long term, and my hold time for these is probably forever. So I bought one more share of Brookfield Corp going up to 26. So while the stock is just selling off, just due to overall fear, I mean, nothing really happened to Brookfield to warrant a 20% sell-off. So I'm going to be purchasing it, every single deposit if it's going to stay down at this price range. And then with Scotiabank, I purchased 8 more shares off of that sale of Power Corp of Canada. Costco, I purchased $3.92 for this company. So just the small leftover dividend from HYLD. So HYLD paid me a little over $27, and I put a little bit into Costco at the 475 range. With ENS, the Enbridge position, it went down a little bit with the market sell-off, so I decided to just purchase one more share since it went below 15. So we're up to 79 shares of this. Pays me every single month. Nice over 10% yield for Enbridge. With ETHY, crypto seems to have been having a little bit of a surge due to the banking crisis. So cryptocurrencies have performed quite well in the previous week, and they're having a nice little rally at the moment. For Google, they actually announced the integration of AI into Google Docs. So they actually did this one day before Microsoft had their presentation about their integration of AI into their Office suite. So kind of a nice little battle going on between Google and Microsoft. And they both had like decent rallies this week, so going up about 12%. So people seem to be, or the market just seems to be heading into technology companies and shifting over into those right now. So that's just an observation, at least from my portfolio and just the general market. HYLD, I purchased 2 additional shares just using my dividend that I get from this. So now this is going to be providing me $28 a month, and it's just going to be growing from there. So I'm just dripping this one. And with the leftover money, I think I'm just going to be putting that into some American stock that I have, just keep it invested in the United States market and continue increasing our passive income each and every month without, depositing any more of my additional money. I would like to drip every stock in my portfolio, although some have much lower yields. So I'll focus on the ones that are more realistic, like the Canadian banks and TELUS, stuff like that. Microsoft has finally rolled into the green, so they're up 2%. With Smart Centers, I purchased one more share, going up to 45. It's paying a little over 7% yield right now, so I think great time to add more real estate to my portfolio, especially since I don't have any real estate outside the stock market. So this is it for me. This is where I get my real estate exposure. For TELUS, I'm continuing to purchase it, so I bought one more additional share, so we went up to 52 shares. So I plan to purchase 4 shares of TELUS each and every month, because at the start of 2023, one of my goals was to double the share count of TELUS so that the quarterly dividend payment would be enough to purchase me 1 additional share of TELUS without putting any more money. And we are getting closer and closer to that goal, so pretty happy to be buying this in a dip. So hopefully it dips even more. I'm pretty happy seeing the share prices of my favorite holdings go on sale. It's like going into your favorite store and seeing things on sale. You have to be calm, know the value of things, and a declining price should not scare you, assuming that the company fundamentals and just the general outlook of the company has not deteriorated in any way. And that's something that you're gonna have to use your judgment on if you're picking individual stocks. If you don't want to research that, then yeah, just stick to ETFs. Nothing wrong with that at all. And with TD Bank, I purchased 6.8 shares of TD Bank, so we're up to over 28 shares of this holding right now. And the sell-off just really isn't warranted with a bank of this quality. The dividend yield is just at a very, very high rate right now, and I think it's a great opportunity to grab TD. And in the previous week for the RRSP, I'm down 2% or down $17, and then all time we're up 133.46 or up 15% all time. and that could be mainly be attributed to Starbucks. So this position has been performing pretty well, up 18% all-time returns, and it's just paying us a nice little dividend that I'm just reinvesting right back into the company. SCHD, I purchased another half a share of this company just because it had a nice little dip, so it's a good opportunity to grab some. And I will be getting a dividend from SCHD later this month that I'm just going to reinvest in the company. And for the new holding, I actually purchased Vici Properties. So this is a real estate investment trust in the United States, and they primarily own real estate in, casinos, Las Vegas. They're even purchasing some casinos in Canada. So they are expanding their operations, and they're even diversifying their business into golf courses. So if we visit allreits.com, which is a fantastic site for REITs, I think it's a great way to just quickly look at the fundamentals of real estate investment trusts. It'll give you the market cap, the price to AFFO, which is the adjusted funds from operations. So you should be using that field to determine, the earnings of a REIT, not the cash flow statement or the earnings statement. They're not quite accurate, and overall it's declined a little bit in the past month, so I thought it was a great time to get in. If we look at their dividends, they do raise them on a consistent basis. They even have decent dividend growth. Their payout ratio is pretty healthy, at least for a REIT, 80%, so they have 20% to reinvested back into the business. They pay around a 5% starting yield, which I like. I don't really like making a lower yield than that in real estate, because I just find that that's not acceptable, especially because a lot of REITs don't grow their dividends that quickly. And if we look at their funds from operation per share, we can see that it's constantly increasing each and every year, which is something you really, really want to see. So with a lot of real estate investment trusts, they'll issue more shares, and typically that would be bad in a different type of company, but real estate investment trusts use this to raise more money, to invest in more properties, make more money, and collect more rent. And this metric will show that, the company, while they do dilute you, they do grow the value to each unit holder through good management. And another reason why I decided to go for this one is because of their CPI inflation rent adjustments that they can raise each and every year to match the rate of inflation, and that protects this REIT a lot more than some other ones. So very happy to get this into the portfolio, and I'll be buying, a little bit of it, whenever I make a buy into my RRSP. I think it's at a decent valuation right now, so I'll just be buying it, slowly, and just keeping it maybe 10% of my RRSP going forward. So if you've watched up to this point, thank you so much, and please like and subscribe to the channel so you never miss an update. And if you're new to investing, the best time is when there's a lot of panic and fear in the market. Feel free to use my link for WealthSimple in the description below, and you can receive up to $3,000 for signing up and making a deposit. So for the dividends earned, I've earned $12.4433 since starting the portfolio. Really good improvement in the annual dividend income projection. So we went from $9.70 to $9.95, so $25 extra per year coming into the portfolio, and I'm very close to hitting that $1,000 a year in dividends goal, which I set out in my my goals for 2023 videos. So do check that out if you haven't. I just go over my thoughts and my plans for the year that I plan to implement in my portfolio. So for the monthly average, we went from 80.86 to 82.97. So nice little increase there, almost $83. The weekly average 19.15 over 18.66 from the previous update. Daily, we're making $2.73 per day. Previously it was $2.66. So itching closer to that $3 a day goal that I set out. The months to earn $100 is how I track the dividend snowball effect. So I'm just tracking how long it takes me to make $100. So when I first started the portfolio, it took me 6.5 months to receive my first $100. And now it's down to 1.21 months, down from the previous 1.24. So it is showing an improvement there. And the portfolio, working 24/7 in the market for me, never sleeping. Got a raise at work, so it went from 47 cents per hour for a 40-hour work week to 48 cents per hour for a 40-hour work week. So pretty good improvement there. And pretty much just in the first 3 months of 2023, we've earned $238.61 in dividend income. And by next month, we should pass the first total year of investing for dividend income, and of course exceeding 2022. So I definitely want to beat this. We are projected to beat it, but it'd be nice to hit 1,000 total or higher for 2023. So in the comments below, let me know if you're buying any of the Canadian banks, or what your purchases were this week. And have a great day, everybody.